So $200,000 they invest, they get nothing back for that first year, but in perpetuity after that, they get their multiplier in the form of monthly returns, or are they just getting a lump sum at the end of at the end of 12 months?
This is a 1-year transaction, in and out. I would stretch it to, I tell people 12 to 15 months just to keep you safe, right? It's probably a 9-month transaction and you will probably get it done in 12. But your PPM will say 12 to 15 months. So you're only going to offer it to one investor for Class A, and they're going to get a 1.25 equity multiple. That's it. They're not getting more than that. They're getting, you put in 100, you get 125 back. There's no monthly dividends. For the other investors, for the Class B investors, they put in $100,000. Let's just call it 15% interest, and we'll give them $1,250 a month.
This is making sense to me. Thank you for walking me through the difference there. I overcomplicated it in my brain for a second.
Yeah. Just 2 share classes, really simple. First person gets a 125 equity multiple. Everybody else gets a 15% interest paid monthly at 15% dividend paid monthly, and your accountant will do all of that stuff.
I've got 2 people actually down for $100,000 so far. Should we raise that Class A equity stake to like 200?
Only if you want to make less money.
Oh, because then we're getting the equity multiplier, which is worth more money to the.
Yep. Give them each 50 and get their full 200, but like give them each 50 for the Class A and give them $50,000 space for the 15% dividend.
They're already happy with a 13%. Like they were like stoked for that. So we can just keep them there. I have another guy I could ask and try to get that.
15. Go to 15.
Okay.
Yeah. If this were a long transaction, the interest would make a difference. This is a short transaction and you want your investors to go, wow.
You're right. Okay. Right? By the way, Alex, I'm like, we need to do this. We need to partner because there's some ideas here that he has, which are just true. You got the experience to bring us through the condoization. I think this is just the way to go. So 15%, and John, that's a very candid discussion right there. Hi, partner. 15% interest on the give, and then a Class A equity stake of 1.25 for a higher level investor, because it essentially is a hard money loan for 1 year. We're just raising more money to get us there.
Yep.
Okay. What if we raise the entire thing at Class B? Like, do we really need the equity multipliers? Do I have enough people in my...
No, you don't. Yeah, if you wanted to raise the full 650 at 15%, it would be, I will do that math. That's easy.
Got 2 guys actually right now that'll be willing to do 15%, and they'll just do the rest of it, 400K.
Great. Yeah. Then there's literally no equity sharing and we keep all the profit. So I'm going to go back to the 400 sale price. Hey, Alec, could you verify what you think the sale, that's the one big question mark in this whole thing, is selling price.
For each condo?
Yeah, that is the big question mark I have.
I have a side question later, but I don't want to derail the conversation. So just remind me that I have a question here for you, John, later.
Yep, do your thing.
I mean, you can go ahead and answer that while I'm looking this up.
That's the big unknown I have is like, you guys are boots on the ground. I can give you all the concepts out there, but we got to verify value. And that's, I think, going to be tough. So shorten the conversation. Seth and I were vacillating between 350 a unit and 400. If we want to be kind and generous to the buyers, 350 is a number. If we want to be more, it sounds like the buyers could actually afford. My goal is to keep principal, interest, taxes, insurance, and HOA at about 20% above what their current rent is, right? That's generally our model. So if they're at a $2,000 a month rent, I'm trying to peg the purchase price at $2,500 a month. And that's how we back into the purchase price per square foot.
So are you doing that based on what their current rents are? Or are you going to be basing that off of what current leasing rates are or in that area?
Great question.
I would go with what they're currently paying. I would just figure a 25% premium above what they're currently paying. And generally speaking, that won't break the bank and they'll start building equity.
Because we're making the money on the interest rate over over the longer term. So
Yeah,
because it doesn't matter if it's, you know, a $20,000 purchase price versus a $80,000 purchase price difference, we're making that an interest over X amount of years. It's fine to us.
Yeah. And really, this model that I've presented, I don't have the owner carry piece into it. It just gets better if we do.
Oh, that's true. You
Yeah,
didn't.
I didn't factor it in.
Cool. I'm cool with doing some owner carry. Like, we don't need this chunk of change necessarily. Having that drip come in and make it more over the long term sounds appealing.
I mean, if we go to the $400,000 per unit, we stand to make about $425,000 on the back end, but we still have that $84,000 on the front end, right? I'm a big fan of walking out of escrow with a check. So if we carry the contract, that's another $250,000 of streaming income over the next 10 years.
Yeah.
And that's what started this whole conversation is you're young, you have limited expenses, and you could essentially be financially free tomorrow if we just started structuring cash flow deals for you.
Right. Which is very appealing to me. I also believe that there's a velocity of money, and I have the ability to be able to find good freaking deals. Like, I've got another one total, like I'll loop you into this one, John. It's an industrial deal. I just got off the phone with CJ, and she's got a familial relation. She knows nothing about industrial. Residential realtor that's like, and she's going to do this deal. I know what I'm doing. I can run circles around here. And we can wrap it up for about, I don't know, 70 cents on the dollar, I think, 60 cents on the dollar. But we have to source a tenant. And so, Alex, you and I are going to be boots on the ground, I am anyways, knocking doors to find a tenant for that St. Pete property on 44th Avenue. And we get a tenant, we sign the lease, we get this thing wrapped up in 3 to 6 months, and we have a full blown tenant in there. Like, I find those deals all the time. And that's without me really trying. Once I start really trying and we have our systems in place, it's just, in the words of my good friend Joe, boom, it's done.
Nice.
By the way, I think the number you could use is 400, but I would like to stress it at 350 to see what that look like. Because why not start higher and then negotiate, make them think they're getting even better of a deal, even though we were fine going down on that price.
And to add to that, why don't we give the church a deal, right? Because they're going to be buying 2 spaces for the price of 1. We can give them a 375 versus a 400 for each space.
Yeah, I'd be really happy with that. Here's what I would do with a church. I'd give them, call it an $800,000 purchase price, and give them and we're going to give you they buy it from us, and then we give them $150,000 donation.
So it's tax write-off and taxes.
We deal with nonprofits all the time.
Dude,
yeah.
and you've got that church experience. Hey, if you've been screwed by them, might as well screw them a little bit too here. I'm just kidding.
Well, I'm not going that direction. I'm saying
I know. I'm just messing. I'm messing. I get it. So walk me through how that looked. How do you give a $150,000 donation back to them in the purchase or in a seller credit, or like, what do you think?
They buy it for full price, and then we walk back and hand them $100,000 as a donation.
Is that something you tell them, or is that something you surprise them with?
No, you tell them up front, I'm going to charge you full price, and then I'm going to give you a donation.
Can we do that? I'm going to be really smart with this. Can we do that in distributions yearly? Because that way we can ensure that they're making their monthly payments.
I don't know. I haven't thought about that. But I mean, the goal here is to incentivize them to pay full price.
Absolutely, which I totally agree with. But then we can give them basically their monthly dividend back in return. Like, hey, we're just going to have like a yearly return on as a thank you. And it essentially is their mortgage back to them, or most of it, to subsidize it. That way we know they're paying, and they can become an anchor tenant.
Yeah. I mean, I could see it both ways. I'd be open for that. I mean, the goal is to incentivize them to pay the full price. And if we happen to give them your second mortgage is $1,500 a month, we're going to give you a credit for $1,500 a month for the next 30.
That's exactly what it comes out to. It's like over a 10-year, I think I did a 5 or 10-year term. I did a 5-year term. $100,000 over 5 years in monthly distributions is $166,000.
Yep.
1666.
Yeah, nice.